Why do seven-figure entrepreneurs use this quantum principle? And how can you copy it to scale your business from six figures to seven without burning out, doubling your team, or gambling on paid ads that drain cash? The answer isn't more hustle. It's not another funnel hack or productivity app. It's a quantum-inspired decision framework that millionaire-level operators use to collapse uncertainty into high-probability wins, leverage entanglement networks for exponential referrals, and engineer coherence rituals that multiply output without adding hours. Over the next 140 minutes, you'll discover the exact principle that separates $100,000 entrepreneurs stuck on a revenue plateau from $1 million plus founders who scale systematically, predictably, and profitably. This principle is called quantum selectivity, the disciplined art of observing all opportunities, measuring potential outcomes with precision, then collapsing your focus onto the single highest leverage path while saying no to everything else. Seven-figure entrepreneurs don't do more. They do less, better, faster, with compounding systems. They apply observer effect presence to close $50,000 deals in 30-minute calls. They run superposition pricing tests that lift average order value by 40%. They activate entanglement loops where one $100,000 client introduces three more. They build coherence into their daily rituals, so they work 25 focused hours per week and outperform competitors grinding 60. You'll learn the 5-phase quantum selectivity system: baseline observation, track the 5 metrics that predict 7 figures, superposition testing, run simultaneous experiments to find your highest ROI lever, entanglement architecture, build self-replicating referral engines, coherence calibration, protect deep work states that 10x productivity, and measurement loops, dashboards that turn data into million-dollar decisions. Each phase includes protocols, micro-stories with real revenue numbers, and stop-iterate rules, so you know when to pivot. If this framework helps you break through your revenue ceiling and scale to 7 figures, subscribe now and save this audio to revisit the protocols whenever you need to recalibrate your quantum business growth strategy. Let's begin. Chapter 1. The Quantum Selectivity Principle. What separates six-figure grinders from seven-figure operators? Most entrepreneurs approaching 7 figures make one fatal mistake. They believe more revenue requires more effort, more clients, more products, more marketing channels, more team members, more hours. This is Newtonian thinking, linear, additive, exhausting. 7-figure operators think quantum, selective, multiplicative, leveraged. The quantum selectivity principle states this: your business exists in a superposition of infinite possible actions at any moment. Launch a new offer, hire a salesperson, run Facebook ads, pitch a partnership, write a book, start a podcast. Most entrepreneurs try to collapse all possibilities simultaneously, spreading energy thin and achieving mediocre results everywhere. 7-figure thinkers observe all options, measure expected ROI with precision, then collapse 80% of their focus onto the one lever with the highest probability of 10x return, and ruthlessly ignore the rest. This isn't about working less for the sake of it. It's about concentrated force. A $500,000 founder juggling 10 projects at 10% focus each generates $500,000. A $2 million founder collapsing 80% focus onto 2 projects at 40% each, while systematizing the rest, generates $2 million from the same weekly hours. The difference is selectivity plus leverage. The quantum parallel is precise. In quantum mechanics, when you measure a particle, its wave function collapses from infinite possibilities into one definite state. In business, when you measure all opportunities, expected revenue, time cost, risk, strategic fit, then decide and commit fully to the highest value path, you collapse business chaos into focused momentum. Momentum compounds. Chaos dilutes. The 5-lever 7-figure entrepreneurs measure daily close rate on high-ticket offers, not total deals. Deals above $10,000. Target: 35 to 50% close rate on qualified $25,000 plus opportunities. Average contract value: ACV 7-figure businesses don't sell $500 offers at scale. They sell $15,000 to $100,000 packages to fewer, better clients. CAC for ideal clients only, not all customers. CAC for clients who stay 18 plus months and refer to plus others. Target: LTV 8, 12x CAC. Revenue per focused hour. Total monthly revenue divided by hours spent on revenue-generating activities. Sales, delivery, strategy. Target, $400 to $1,200 per hour. Referral velocity. Number of warm intros received per closed client. Target, 1.5 to 3 referrals per client within 90 days of project completion. Most six-figure entrepreneurs track revenue and expenses. Seven-figure operators track leverage ratios, metrics that reveal whether their business model can scale without proportional increases in time or cost. Let me tell you, Daniel's $1.8 million year, by saying no to 90% of opportunities, Daniel ran a $480,000 per year consulting business and was exhausted. He said yes to every project. $3,000 strategy sessions, $12,000 implementations, $50,000 retainers, workshops, speaking gigs, podcast interviews. He tracked his time for 30 days and discovered he spent 62 hours per week generating $40,000 per month, $161/hour. Unsustainable. He listed every revenue stream and calculated ROI per hour. The $50,000 retainers took 8 hours per week and closed at 45%. The $3,000 sessions took 6 hours per week and closed at 18%. He made a quantum decision. Kill everything under $25,000. Focus 100% on landing three $50,000 plus retainer clients per quarter. He lost $18,000 in small deal revenue the first month. But within 90 days, he closed two $60,000 and one $75,000 retainer, $195K in 1 quarter, working 30 hours per week. By month 12, he hit $1.8 million annual revenue with 4 team members and 25 focused hours/week. Lesson: subtraction before addition, selectivity before scale. Protocol 1.1. The 7-figure baseline audit, quantum selectivity diagnostic, objective. Identify your current leverage ratios and the single highest ROI path to 7 figures within 7 days. Inputs: last 90 days of revenue data by offer/client tier. Time tracking log. If unavailable, estimate hours per revenue stream. Close rate data for each offer tier. CAC and LTV estimates by client segment. Steps: Day 1 to 2, 120 minutes export all revenue data. Segment by offer. Under $5,000, $5,000 to $15,000, $15,000 to $50,000, $50,000 plus. Calculate revenue per tier. Day 3, 90 minutes estimate time spent per tier, sales plus delivery plus admin. Calculate revenue per hour for each tier, total tier revenue divided by total hours. Day 4, 60 minutes calculate close rate per tier, deals 1 divided by total opportunities. Note which tier closes fastest/highest. Day 5, 60 minutes estimate CAC per tier. Calculate LTV, CAC ratio. Identify which tier has the best economics, highest. LTV, CAC plus highest revenue/hour. Day 6 to 7, 90 minutes make the quantum decision. Which one offer tier, if you focus 80% of your energy there, would most likely generate $1 million plus annual revenue? Write it down. Commit for 90 days. Measurement, KPI, revenue per hour by offer tier. Target: identify the tier with $300 plus per hour potential and 8x plus LTV, CAC. Sample report. Under $5,000 tier, $95 per hour, 22% close, 3.2x LTV, CAC. $50,000 plus tier, $520 per hour, 42% close, 11x LTV, CAC. Decision: focus 80% energy on $50,000 plus tier. Stop/iterate rules. If no tier shows $300 plus per hour, your pricing or positioning is broken. Revisit offer design before scaling. If data is incomplete, run this audit after 30 days of disciplined tracking. Revisit every 90 days as business evolves. Ethics note: selectivity doesn't mean abandoning existing clients or burning relationships. It means designing your future pipeline around your highest leverage work and gracefully transitioning out of low ROI activities. Chapter 2. Observer Effect in $50,000 plus sales calls. How presence closes high-ticket deals faster in quantum mechanics. The observer effect means the act of observation changes the system. In high-ticket sales, your energetic state during a $50,000 plus discovery call literally alters the buyer's decision-making process. Neuroscience confirms this. Mirror neurons cause prospects to unconsciously match your confidence, urgency, and certainty. If you enter a call anxious about closing, the prospect mirrors hesitation. If you enter calm, grounded, and detached from outcome, the prospect mirrors trust and decisiveness. Seven-figure entrepreneurs don't pitch $50,000 deals. They observe whether mutual fit exists, then guide the prospect to self-discover the decision. This shift from convincing to witnessing changes tonality, question depth, and listening quality, which high-net-worth buyers interpret as authority and mastery. The protocol: 20-minute pre-call priming ritual for every high-ticket opportunity. This includes nervous system reset, breath work, movement, mental anchoring, reviewing offer value out attachment, and intention setting. I'm here to discover fit, not force a sale. Sales data from seven-figure consultancies shows that sellers who prime before calls close 28 to 42% more high-ticket deals than those who don't. The three observer effect layers for high-ticket closing. Layer 1. Pre-call nervous system calibration, 20 minutes. High-ticket buyers are sophisticated. They detect desperation, rushed energy, or script reading within 90 seconds. Seven-figure closers enter calls in parasympathetic dominance, calm, present, unhurried. The protocol: 20 minutes before the call, step away from screens. Breathe for second inhale, 6-second exhale, 15 reps. Walk or stretch for 10 minutes. Visualize the call going well, and also visualize it being a no, and feeling fine with that outcome. This detachment paradoxically increases close rates because you stop needing the sale and start serving conversation. Layer 2. Question architecture. First 10 minutes of call. The first question sets the frame. Weak: tell me about your business. Strong: what's the one business challenge that, if solved in the next 90 days, would unlock $500,000 plus in value for you? This question forces a prospect to think big, quantify impact, and self-anchor to urgency. Seven-figure closers ask 3 to 5 deep questions in the first 10 minutes, then stay silent for 5+ seconds after each answer. Silence activates the prospect's prefrontal cortex, forcing articulation of real pain instead of surface objections. Layer 3. The collapse moment, transition to offer. After deep discovery, seven-figure closers don't transition to the pitch. They name the pattern they observed. So if I'm hearing you correctly, the core issue is X, which is costing you Y per month, and if we solve it, you unlock Z. Is that accurate? The prospect says yes. Observer effect. They just affirmed their own problem and the value of solving it. Then you say, great, here's exactly how we solve that, the investment and the timeline. Let me walk you through it. No hype, no urgency tricks, just clarity and confidence. Micro story. Vanessa's $85,000 close in 28 minutes. Vanessa ran a branding agency targeting 8-figure companies. She had a discovery call with a VP of marketing at a $12 million SaaS company. She was nervous. It was her largest opportunity ever. She almost skipped her priming ritual because she was too busy, but she forced herself. 10-minute walk, breath work, mental rehearsal of both yes and no outcomes. She entered the call calm. First question: what's costing you the most revenue right now? Customer acquisition or retention? VP paused, then said, honestly, retention. We're losing $200,000 per month to churn because our messaging is inconsistent. Vanessa stayed silent for 7 seconds. VP continued unprompted. If we fix that, we'd save $2.4 million annually. Vanessa asked 2 more deep questions and summarized. So the core issue is messaging fragmentation, costing you $2.4 million per year. If we align your brand across all touchpoints in 90 days, you recapture that. Accurate. VP, exactly. Vanessa presented her $85,000 brand strategy package. VP, when can we start? Call lasted 28 minutes. Close rate on that tier jumped from 31% to 48% over the next 60 days once she applied the observer effect consistently. Lesson: presence is the highest leverage sales skill you can develop. Protocol 2.1, the 20-minute high-ticket priming ritual objective. Increase close rate on $25,000 plus opportunities by 15 to 30 percentage points within 60 days by entering every high-ticket call in a coherent, present state. Inputs: calendar with all high-ticket discovery calls blocked. Quiet space or noise-canceling environment. Timer. Steps: 20 minutes before call. Minutes 1 to 5. Breath work set timer. Close laptop. Sit or stand upright. Breathe. For second inhale, 6-second exhale. Repeat 15 times. Clear mental clutter. Minute 6 to 10 movement walk. Indoors or outdoors, no phone. Shake out tension. Smile. Activates positive neural circuits, even if forced. Minutes 11 to 15, mental anchoring. Visualize the call. See the prospect relaxed, asking great questions, saying yes. Then visualize them saying no, and feel okay with it. Detach from outcome. Minute 16 to 20, value review. Write one sentence. I help to achieve outcome in time frame worth value. Example: I help 8-figure SaaS companies fix messaging fragmentation in 90 days, recapturing $1 million to $3 million annual revenue. Read aloud twice. Anchor to the value, not the sale. During call, execution, ask one deep, high-value question in first 3 minutes. Stay silent 5+ seconds after their answer. Let them lead the discovery. When you present the offer, name the pattern you observe first, then show the solution. Measurement. KPI. Close rate on $25,000 plus opportunities. Deals won divided by qualified high-ticket calls. Weekly review. Track prime calls versus unprimed. Compare close rates. Target: 15 to 30 percentage point lift within 60 days, e.g., 28%, 43%. Stop/iterate rules. If close rate doesn't improve by day 30, record one call and audit. Are you asking D questions? Are you staying silent? Are you detached from outcome? Or do you sound desperate? If you skip priming more than twice/week, recommit or shorten the 10-minute version. Ethics note: priming improves your state, not the prospect decision. If your offer isn't a fit, no priming will or should force a close. Use this to serve better conversations, not manipulate unqualified buyers. Chapter 3. Superposition pricing for 7-figure revenue. Testing $27,000 versus $30,000 to maximize ACV in quantum physics. Superposition means a system exists in multiple states until measured. In 7-figure businesses, your offer price exists in multiple optimal points until you test and measure. Most entrepreneurs pick a price based on competitor research or gut feel, then defend it forever. 7-figure operators run micro-variation pricing tests on high-ticket offers to collapse uncertainty into maximum average contract value. The most powerful test at the 7-figure level: $27,000 versus $30,000, or $48,000 versus $50,000. These aren't dramatic differences, but psychological pricing research shows that perceived value shifts significantly between charm pricing, ending in 7, 8, 9, and round pricing, ending in 0. Charm pricing can signal deal or calculated value. Round pricing signals premium positioning and confident authority. The only way to know which resonates with your ICP is to test. Here's the 7-figure protocol. Split high-ticket proposals into 2 groups. Group A sees $27,000. Group B sees $30,000. Everything else identical: scope, deliverables, timeline. Track conversion rate, buyer quality, measured by engagement and referral rate, and negotiation friction. After 20 to 30 exposures per variant, you'll have data. Often a surprising result isn't which price converts better. It's which price attracts clients who stay longer, refer more, and demand less hand-holding. Microstory. Greg's $3,000 price shift that added $240,000 annually. Greg ran a consulting firm offering $27,000 strategy packages. His close rate was 38%. A mentor suggested testing $30,000. Greg resisted. That's only $3,000 more. It won't matter. But he split tested anyway. Over 90 days, 14 prospects saw $27,000. 6 closed, 43% conversion. Another 15 saw $30,000. 6 closed, 40% conversion. Conversion nearly identical. But the $30,000 clients had 2.3x higher referral rate. Each introduced 2.1 new prospects versus 0.9 for $27,000 clients, and 35% lower support requests. They valued engagement more and came prepared. Annualized impact. 8 extra referrals equals 3 extra closes equals $90,000. Lower support time equals 40 freed hours equals 2 extra client slots equals $60,000. Total annual lift from the $3,000 price shift. $240,000 plus when you factor in referrals, efficiency, and positioning. Lesson. Small price changes create asymmetric downstream effects when you measure beyond conversion rate. The 7-figure pricing superposition framework layer 1. Charm versus round pricing, $27,000 versus $30,000. Charm pricing, $27,000, $48,000, $97,000, can feel strategic and calculated, appealing to analytical buyers. Round pricing, $30,000, $50,000, $100,000, feels authoritative and premium, appealing to buyers who value simplicity and brand. Your ICP determines which wins. Test both for 60 to 90 days. Layer 2. Anchoring with strategic add-ons. Don't just test price. Test tiered structures. Example, Core, $30,000. Enhanced, $50,000 with faster delivery plus bonus audit. Premium, $75,000 with ongoing support. The $75,000 tier makes $50,000 feel reasonable. The $30,000 makes $50,000 feel premium. This is choice architecture rooted in behavioral economics. Prospects are more likely to choose the middle option when framed correctly. Layer 3. Value-based pricing language when presenting high-ticket pricing. Never lead with a number. Lead with the ROI multiple. Example. This solves your $2.4 million churn problem in 90 days. The investment is $85,000, about 3.5% of the annual value you recapture. Does that make sense? The prospect here's 3.5% cost for 100% solution instead of $85,000 sticker shock. This isn't spin, it's framing value accurately. Protocol 3.1. The 90-day high-ticket pricing superposition test objective. Increase average contract value by 8 to 20% within 90 days by testing 2 price variants and selecting the winner based on conversion, client quality, and downstream referral rate. Inputs. Current high ticket. Offer price $15,000 plus. Pipeline of 30 plus qualified prospects over 90 days, minimum 15 per variant. CRM or spreadsheet to track variant, conversion, ACV, and 90-day client quality metrics. Steps. Day 1 to 5, 90 minutes, choose your core high-ticket offer. Note current price. Create 2 variants. Variant A, charm price, e.g. $27,000, and variant B, round price, e.g. $30,000. Ensure all messaging, scope, deliverables identical except price. Days 6 to 10, 60 minutes setup split assignment. Alternate proposals. Prospect 1 gets A, Prospect 2 gets B, etc. Or split by lead source if you have 2 clean channels. Log in CRM. Prospect name, variant AB, date converted Y/N, price paid. Day 11 to 90, 5 minutes for proposal. Every time you send a proposal, log variant and outcome. Track. Conversion rate, negotiation request, do they ask for discount? Referral rate, 90 days post-close. Support tickets, engagement quality. Day 91 to 95, 120 minutes, analyze. Calculate. Conversion percent or variant, average ACV, referral rate, referrals received divided by clients closed, support intensity, tickets or hours per client. Choose winner based on total value, conversion times ACV times referral multiplier. Measurement. KPI, average contract value, conversion rate, referral rate, client quality, low maintenance equals high quality. Target: 8 to 20% ACV lift or significant improvement in client quality metrics. Sample report. Variant A, $27,000, 42% conversion, $27,000 ACV, 0.9 referral/client, 12 support hours average. Variant B, $30,000, 38% conversion, $30,000 ACV, 2.1 referral/client, 7 support hours average. Winner. Variant B, higher ACV plus better clients plus lower support costs plus 2.3x referrals equals $180,000 plus annual impact. Stop/iterate rules. If sample size under 12 per variant by day 60, extend test to day 120. If conversion rates within 3% and other metrics similar, choose higher price. Signals authority and attracts better clients over time. Retest annually as market positioning and sophistication evolve. Ethics note: price testing is ethical when both prices are fair, profitable, and aligned with value delivered. Never test prices you can't sustain or that compromise service quality. Chapter 4. Entanglement Architecture: building self-replicating referral engines that generate $300,000 plus annually. Quantum. Entanglement describes particles that remain connected across distance. When one changes state, the other responds instantly. In seven-figure businesses, entanglement is a network effect of strategically designed relationships. One thrilled $50,000 client introduces 2 more $50,000 prospects. One strategic partner sends 10 qualified $30,000 leads. One case study attracts 15 inbound $25,000 inquiries. This is exponential growth without ad spend. The key insight: seven-figure entanglement is architected, not accidental. Most six-figure entrepreneurs hope for referrals. Seven-figure operators engineer referral inevitability through systematic value delivery, strategic exit protocols, and reciprocal partnership loops. The math is compelling. If every high-ticket client refers 1.8 new clients on average, and you close 40% of those referrals, your CAC drops 60% and revenue compounds 40 to 70% year over year, without increasing marketing spend. The 3 entanglement systems that scale to seven-figure. System 1. The referral protocol embedded into client onboarding. Most entrepreneurs ask for referrals awkwardly at the end of the project. Seven-figure operators set referral expectations at the beginning. During onboarding, they say, "Our best clients come from referrals. If we deliver exceptional results, and we'll ask you to introduce us to 2 people in your network who'd benefit from similar outcomes." Does that sound fair? The client agrees up front. At project completion, the ask isn't a surprise. It's a fulfilled agreement. Referral rate jumps from 15 to 25% reactive asking to 55 to 75% proactive agreement. System 2. The strategic partner map. 5 to 10 complementary businesses. Seven-figure entrepreneurs don't compete. They co-opete. They identify 5 to 10 businesses serving the same ICP but offering complementary services, e.g., if you do branding, partner with web developers, CRM consultants, PR agencies. The protocol: reach out with a value-first offer. I serve ICP. You do service. I'd love to send you qualified leads when my clients need your thing. Can I intro you to one this week? Lead with generosity. Most reciprocate. One quality partner can send 8 to 20 warm, pre-qualified $25,000 plus leads per year, worth $200,000 to $600,000 in pipeline. System 3. The case study engine. Turn every win into an attraction asset. Every significant client result becomes a published case study, 400 to 600 words, structured as problem-solution result with specific numbers. Post on your website, LinkedIn, email list, and send directly to prospects in your pipeline. Seven-figure case studies include client name, if allowed, industry, revenue size, specific problem, exact deliverables, measurable outcome, $X saved, Y% growth Z months, and one client quote. One well-written case study can generate 15 to 30 inbound inquiries over 18 months, with 20 to 35% converting to discovery calls. Micro-story. Laura's $420,000 in 12 months from one strategic partnership. Laura ran a leadership development firm serving $5 million to $50 million companies. She met a fractional CFO at a conference who served the same market. Instead of competing, Laura proposed collaboration. When my clients need financial restructuring, I'll send them to you. When yours need leadership coaching, send them my way. She sent him 3 qualified intros in the first 60 days. He reciprocated with 2. Both closed. Over 12 months, he sent her 7 qualified $30,000 to $80,000 opportunities. She closed 5. Total revenue from one entangled partnership, $420,000. Her cost? 3 hours of relationship building and consistent generosity. She didn't pay for ads. She didn't cold call. She architected one high-trust relationship and let entanglement do the rest. Lesson: one strategic partnership is worth 10,000 cold emails. Protocol 4.1. The 60-day entanglement architecture sprint objective. Generate 8 to 15 warm referrals or partner source $25,000 plus leads within 60 days by installing referral protocols and activating strategic partnerships. Inputs: list of current and past clients, last 18 months. List of 10 to 15 complementary businesses serving your ICP. One recent client success story, result data, testimonial, or metrics. Steps: day 1 to 10, 120 minutes install referral protocol. For next 3 client onboardings, add this to kickoff. Our best clients come from referrals. If we deliver exceptional results, we'll ask you to introduce us to 2 people in your network. Sound fair? Log client agreement Y/N. Day 11 to 20, 90 minutes conduct referral exit interviews with 3 recent successful clients. Script: what result did you get? What surprised you? Who else in your network faces similar challenges? Can you introduce me to 2 people? Track referrals received. Day 21 to 35, 150 minutes build strategic partner map. Identify 5 to 10 businesses serving your ICP. Complementary, not competitive. Reach out. I serve ICP. You do service. I'd love to send you leads when my clients need your service. Can I intro you to one this week? Send 1 warm intro immediately to demonstrate value-first approach. Day 36 to 50, 120 minutes write 1 detailed case study. 400 to 600 words client name/industry. Problem quantified. Solution deliverables. Result, specific numbers. Client quote. Post on LinkedIn, website, and send to 5 active prospects in your pipeline. Day 51 to 60, 60 minutes follow-up on partner intros and referral requests. Track: referrals received, partner leads received, case study inquiries. Log warm leads generated. Measurement: KPI, number of warm referrals and partner leads received, qualified $25,000 plus opportunities. Target: 8 to 15 warm, pre-qualified leads within 60 days. Sample report: referral exit interviews. 3 conducted. For intros received, 2 book discovery. Partner outreach: 6 contacted, 3 active. 7 leads received, 3 book discovery. Case study: 82 views, 6 inbound inquiries, 2 discovery calls booked. Total: 13 warm leads, 7 discovery calls, 3 proposals sent. Stop/iterate rules: if no referrals by day 20, revisit exit interview script. Make ask clearer or lower friction, just 1 name instead of 2. If partners don't respond, lead with even more value. Send them 2 to 3 intros before asking for 1 back. If case study doesn't generate inquiries, improve headline and result quantification, weak. Help client grow, strong. Help client add $1.2 million revenue in 6 months. Repeat this sprint every 90 days to maintain entanglement momentum. Ethics note: entanglement is built on genuine value exchange. Never pressure clients for referrals before delivering results. Never promise partners more than you can deliver. Authenticity sustains entanglement. Transactional behavior kills it. Chapter 5. Coherence Calibration. The deep work system that unlocks $800 plus per hour productivity in quantum physics. Coherence refers to waves synchronized and amplifying each other. In 7-figure businesses, coherence is a mental state where distraction vanishes, decision fatigue disappears, and you enter sustained flow, producing 10x more value per hour than scattered mode. Neuroscience research shows that flow states increase productivity by 500% and creativity by 400%. For seven-figure entrepreneurs, this translates to 1 hour of coherent deep work equaling 5 hours of reactive, multitasking work. The challenge: modern business environments are designed to destroy coherence. Slack notifications, email, Zoom fatigue, context switching. Seven-figure operators engineer coherence by design through dopamine protection rituals, 90-minute deep work blocks, and strict boundary enforcement. The core protocol: the first 120 minutes of your workday are sacred and untouchable. No email, no Slack, no meetings, no phone. You enter with a single high-leverage intention: close a $50,000 deal, write a strategic plan, design a new offer, execute an uninterrupted flow, then break. This creates the neurochemical foundation for $800 to $1,200 per hour productivity. The coherence stack: 5 layers for seven-figure focus. Layer 1. Morning dopamine lockdown for 60 minutes after waking. Your brain's dopamine baseline determines focus capacity for the entire day. Checking email or social media within the first hour spikes dopamine artificially, then crashes you below baseline, creating craving, distraction, and reactive mode. Seven-figure operators protect morning dopamine. Wake, hydrate, 16 to 20 ounces water. Move, 10 to 15-minute walk or stretch, then enter work. No phone until 9 a.m. minimum. This keeps dopamine stable and focus sustainable. Layer 2. The 120-minute deep block, single task execution. Your prefrontal cortex can sustain peak focus for 90 to 120 minutes before needing rest. Seven-figure entrepreneurs schedule their hardest, highest leverage task, revenue-generating, strategic creative, in the first 120 minutes of work. Use website blockers, freedom, cold turkey. Phone on airplane mode, door closed. One task: full presence. This single block often produces more business value than the entire rest of the day. Layer 3. Ultradian rhythm recovery. 15-minute break every 90 to 120 minutes. After deep work, your nervous system needs recovery. Seven-figure operators respect ultradian rhythms, natural 90-minute cycles of focus and rest. After 90 to 120 minutes, take 10 to 15 minutes. Walk, breathe, hydrate, stretch. Don't scroll or check email. That defeats recovery. This rest phase restores focus capacity for the next block. Layer 4. Batching low-leverage tasks. Afternoon 60-minute blocks. Email, Slack, admin, quick calls. Batch these into dedicated 60-minute windows in the afternoon when cognitive energy is lower. Seven-figure entrepreneurs don't check email throughout the day. They check twice, 1 p.m. and 4 p.m., 30 minutes each. This prevents constant context switching and preserves coherence. Layer 5. Weekly deep work audit. Sunday planning. Every Sunday, seven-figure operators review the coming week and block 10 to 15 hours of deep work on the calendar, Monday through Friday, 2 to 3 hours per day. These blocks are non-negotiable, treated like client meetings. If someone requests a meeting during deep work time, the answer is, "I'm booked then. How about alternative time?" This discipline is what separates $200,000 per year grinders from $2 million per year operators working fewer hours. Micro story: Jason's revenue jumped from $680,000 to $1.9 million. By working less, Jason ran a $680,000 per year agency and felt perpetually behind. He worked 55 to 60 hours/week, but spent most of it firefighting: email, Slack, team questions, client check-ins. He tracked his time for 2 weeks. Only 11 hours were spent on true revenue-generating or strategic work. The rest was reactive noise. He implemented coherence calibration. No phone until 9 a.m. First 120 minutes on one high-leverage task. Sales calls, strategy, new offer design, website blocker active, deep work block sacred on his calendar. Week 1 felt uncomfortable. His team pinged him. He had FOMO, but he held the boundary. By week 3, his deep work hours jumped to 18/week. By week 8, He closed three $85,000 deals he'd been too busy to pursue before. He hired a COO to handle operations, freeing another 8 hours per week for deep work. 12 months later, $1.9 million revenue, 35 focus hours/week, 2-week vacations every quarter without touching email. Lesson: less reactive time, more coherent time equals exponential revenue growth. Protocol 5.1, the 60-day coherence transformation, deep work system install. Objective: add 12 to 20 hours of high-leverage deep work per week within 60 days, increasing revenue per hour by 40 to 80%. Inputs: calendar, block first 120 minutes of workday, Monday through Friday. Time tracking tool, Toggle, Clockify, or Paper Log. Website blocker app, Freedom, Cold Turkey. Team communication boundaries. Set do not disturb hours. Steps: day 1 to 3, 90 minutes audit last 2 weeks' time. Categorize: deep work, high leverage, sales strategy creation, shallow work, email, admin meetings, reactive, firefighting, interruptions. Calculate deep work percent of total hours. Day 4 to 7, daily install morning dopamine lockdown. Wake, hydrate, move 10 minutes. No phone until work starts. Log compliance, Y/N. Day 8 to 60, daily, 120 minutes each morning block. First 120 minutes for one deep task. Set phone to airplane mode. Activate website blocker. After 120 minutes, take 15-minute break. Walk, breathe. Track deep work hours daily. Day 15, 30, 45, 60, 30 minutes each weekly audit. Compare deep work hours week over week. Identify friction points, interruptions, boundary violations. Adjust. Communicate boundaries to team. Decline non-essential meetings. Automate shallow tasks. Day 61, 60 minutes final audit. Compare week 1 versus week 8 deep work hours. Calculate revenue per hour improvement. If revenue increased with fewer total hours, RPH skyrocketed. Measurement: KPI, deep work hours per week, revenue per hour, monthly revenue divided by total work hours. Target: increase deep work hours by 12, 20/week. Increase RPH by 40 to 80%. Sample report: week 1, 9 deep work hours, $680,000 annual revenue divided by 2,400 hours per year equals $283 per hour. Week 8, 22 deep work hours, 35 total work hours/week. Month 2, $120,000 revenue month divided by 140 hours equals $857 per hour. Deep work lift, plus 13 hours/week. RPH lift, plus 203%. Stop/iterate rules. If deep work hours don't increase by day 20, identify boundary violations. Are you letting team/client interrupt? Are you checking email during deep work blocks? Recommit or delegate interruptions. If 120-minute blocks feel too long initially, start with 90 minutes and build up. Repeat audit every 90 days to prevent regression. Ethics note: coherence maximizes leverage but doesn't eliminate hard work. It amplifies output per hour, not magic. Respect your nervous system. Avoid chronic overwork even in flow states. Chapter 6. Negotiation Neuroscience for $100,000 plus deals. The 5-layer yes architecture negotiation at the 7-figure level isn't about persuasion tactics or closing tricks. It's about neurochemical momentum engineering. Neuroscience research shows that the human brain releases dopamine when it says yes to small, agreeable statements. Each yes lowers resistance, primes the brain for the next yes, and creates decision momentum toward the close. 7-figure entrepreneurs use a 5-layer yes architecture for $50,000 to $150,000 deals. Get 5 microagreements before presenting the investment, and your close rate on high-ticket opportunities increases 22 to 38%. This is a manipulation. It's alignment engineering. You're helping the prospect articulate what they already want and building neural momentum toward the decision they need to make. The 5 yes layers for $100,000 plus deals. Yes number 1. Problem acknowledgement. First 3 minutes. Start with a question so obvious they can't disagree. Most companies at your scale struggle with specific pain. Is that true for you? Or it sounds like pain point is costing you estimated cost. Would you say that's accurate? This first yes establishes truth-telling and rapport. The prospect feels heard. Yes number 2, quantified impact, minutes 4 to 8. Confirm the cost of inaction with precision. So if this problem persists for another 12 months, it'll cost you approximately, calculate, $X/month times 12 equals $Y. Is that a fair estimate? The prospect says yes and now owns the quantified pain. This anchors the value of solving it. Yes number 3, outcome desire, minutes 9 to 12. Confirm they want the solution and the transformation unlocks. If you could solve problem in time frame, that would unlock specific outcome, revenue growth, cost savings, time freedom, correct? This yes connects pain to aspiration and builds motivation. The prospect is now emotionally invested in the solution. Yes number 4, timeline urgency, minutes 13 to 16. Establish that solving this soon matters more than solving it later. And the sooner you solve this, the less you lose the problem and the faster you capture the upside, right? This yes creates urgency without pressure. It's logical, not manipulative. The prospect self-anchors to now, not later. Yes number 5, logical next step, minutes 17 to 20. Bridge to your offer without asking for the sale yet. So if I can show you a proven system to solve problem, achieve outcome in time frame, for an investment at a fraction of the annual value you'll recapture, it makes sense to at least explore whether to fit. Agreed? This yes removes objection barriers and frames your offer as the obvious next move, not a risky leap. After 5 yeses, you present the offer. Here's exactly how we do it. The scope is deliverables. The timeline is duration. The investment is $X. Based on everything we've discussed, does that align with solving your $Y annual problem? At this point, resistance is minimal. You're having a buying conversation, not a convincing battle. Micro story. Mark's $140,000 close in 34 minutes. Using the 5S architecture, Mark sold enterprise software implementation services. He had a call with a COO at a $25 million logistics company. The deal size, $140,000. Mark used the 5 yes structure. Yes number 1. Inventory errors are costing you time and money. Is that accurate? So absolutely. Yes number 2. If you're losing $50,000 per month to errors and inefficiency, that's $600,000 annually. Fair estimate. COO. Actually, probably closer to $700,000. Even better, prospect self-escalated the pain. Yes number 3. If we eliminate 80% of those errors in 6 months, you'd recapture $560,000 annually going forward. That would be transformational, right? COO. Yes, that's exactly what we need. Yes number 4. And the sooner you implement, the less you bleed and the faster you stabilize operations, correct? COO, correct. Yes number 5. So if I can show you a system to do this in 6 months or a fraction of the annual savings, it's worth exploring? So, definitely. Mark presented the $140,000 package, framed as 20% of first-year savings. So, let me run it by the CFO, but I'm ready to move forward. Deal closed within 48 hours. Call lasted 34 minutes. Mark's close rate on $100,000 plus deals went from 29% to 51% once he systematized the 5S architecture. Lesson: momentum is built in microagreements, not in the final ask. Protocol 6.1. The 60-day 5S integration, high-ticket negotiation system. Objective: increase close rate on $50,000 plus deals by 20 to 35 percentage points within 60 days by integrating the 5S architecture into every high-ticket discovery call. Inputs: list of your ICP's top 3 to 5 pain points from past client interviews or discovery calls. Script template for 5 yes questions written in practice. Call recording tool, Zoom, Gong, or detailed note-taking system. Steps: Day 1 to 5, 90 minutes. Write your 5 yes questions tailored to your offer. Yes number 1, problem acknowledgement. Yes number 2, quantified impact. Yes, number 3, outcome desire. Yes, number 4, timeline urgency. Yes, number 5, logical next step. Practice aloud 5 to 10 times until conversational, not scripted. Days 6 to 60 per call. 10 minutes prep before every high-ticket discovery call. Review your 5 yes script. During call, ask all 5 questions in sequence within first 20 minutes. Track. Did you get 5 yeses, Y/N? Did prospect close, Y/N? Log in CRM. Day 30, 60 minutes midpoint review. Analyze first 15 calls. Compare close rate on calls where you got 5 yeses versus calls where you didn't. Identify friction points. Which yes is hardest to get. Adjust question phrasing for clarity. Day 61, 90 minutes full analysis. Calculate close rate with 5 yes versus baseline. Calls without structure. Document improvement. Refine script based on what worked best. Measurement. KPI. Close rate on $50,000 plus opportunities. Deals closed divided by qualified high-ticket calls. Target. 20 to 35 percentage point increase, e.g., 26%, 46%. Sample report. Baseline close rate. No structure, 26%. 5 yes close rate, 48%. Lift, plus 22 points. Sample size. 28 calls, 14 with structure, 14 without. Stop/iterate rules. If yeses feel forced or scripted, revise to sound more conversational and natural. If close rate doesn't improve by day 40, record 1 call and audit. Are you asking yeses too fast? Are you listening to answers or rushing? Are you genuinely curious or performing? Revisit and refine script every 90 days as your offer and market evolve. Ethics note. The 5 yes architecture builds momentum through alignment, not manipulation. If the prospect is a fit, no momentum should push them to buy. Use this to help aligned buyers move forward faster, not to close misaligned ones. Chapter 7. Marketing Resonance Engineering. Mining ICP language to generate $500,000 plus inbound pipeline in physics. Resonance occurs when one object's vibration frequency matches another's, amplifying the effect exponentially. In 7-figure marketing, resonance is when your messaging language matches your ideal customer's internal dialogue so precisely that they feel magnetically drawn to you, not convinced but recognized. Most entrepreneurs write marketing from their perspective. We help businesses scale with proven systems. Generic, forgettable. 7-figure operators write from the customer's exact internal voice. You're stuck at $800,000 annual revenue. You've tried hiring better funnels, new offers, but nothing breaks you past $1 million. Here's why. You're optimizing the wrong leverage points. Let me show you the 3 you're missing. The second version uses verbatim language your ICP uses when describing their frustration. It resonates because it mirrors their frequency. The protocol. ICP language mining. Spend 8 to 10 hours interviewing 8 to 12 ideal clients or prospects. Ask, what was the problem before you found us? What exact words did you use to describe it to yourself? What did you try that failed? What made you finally decide to act? Record verbatim phrases. Then deploy those exact phrases into headlines, ads, emails, and sales scripts. When prospects see their own words reflected, they stop scrolling and start engaging. The resonance mining system for 7-figure inbound step 1. The voice of customer deep interview. 8 to 12 interviews, 30 minutes each. Interview 8 to 12 past or current clients who represent your ideal customer profile. Ask 7 questions. What specific problem were you facing before you found us? Listen for exact phrases. How did you describe that problem to yourself or colleagues? Capture internal dialogue. Where had you tried before that didn't work? Reveals objections and failed solutions. What was the emotional cost of problem? Uncovers motivation beyond logic. What made you finally decide to take action with us? Identifies trigger events. How would you describe the result you got in 1 sentence? Outcome language. If you were recommending us to appear, what would you say? Referral messaging. Record answers verbatim. Look for repeated phrases, emotional language, specific pain descriptors, and outcome framing. These become your marketing gold. Step 2. The language map 3-column framework. Create a document with 3 columns: pain language, desire language, objection language. Fill each with exact phrases from interviews. Example for a $50,000 consulting offer. Pain: I'm working 60-hour weeks but stuck at $800,000. I can't break $1 million no matter what I try. Desire: I just want to hit $1.5 million without hiring 10 more people or burning out. Objection: I've hired 3 consultants before and nothing stuck. I need something that actually works. Step 3. The resonance rewrite. Apply to all marketing assets. Take your homepage headline, ad copy, email subject lines, and sales scripts. Replace generic language with ICP phrases from your language map. Before generic, we help entrepreneurs scale their businesses efficiently. After resonant, stuck at $800,000 and can't break $1 million? Here's why, and the 3 leverage points you're missing. Test new copy for 60 days. Measure CTR, click-through rate, lead quality, discovery to close rate, and CAC. Resonant copy typically lifts CTR by 40 to 120% and improves lead quality by 25 to 60%. Fewer tire kickers, more qualified buyers. Step 4. The continuous feedback loop every quarter. Conduct 2 to 3 new interviews. Markets evolve, language shifts, pain points change. 7-figure operators treat ICP language mining as an ongoing system, not a one-time project. Fresh language keeps marketing resonant as your business scales and your ICP sophisticates. She applied. Nina's $680,000 inbound pipeline from one language shift. Nina ran a $1.2 million marketing agency targeting $5 million to $20 million e-commerce brands. Her website headline read, Full-service marketing agency for growing e-commerce brands. CTR on her ads, 1.4%. Inbound leads, 5/month, mostly unqualified. She conducted 10 client interviews and heard the same phrase 5 times. We're doing $10 million in revenue, but only keeping $800,000 profit. We're growing broke. She rewrote her headline. Doing $10 million, but only keeping $800,000? You're growing broke. Here's how to fix it in 90 days. New ad CTR, 4.7%. Inbound leads, 18/month. Lead quality jumped. Discover to close rate went from 14% to 32% because the language pre-qualified serious buyers who self-identified with that exact pain. Over 12 months, that one headline shift generated $680,000 in new pipeline and $340,000 in close revenue. Same offer, same expertise, different language. Lesson: your customers' words are better than your clever copy. Protocol 7.1. The 90-day ICP language mining and resonance rewrite objective. Double inbound lead quality and reduce CAC by 25 to 50% within 90 days by mining and deploying ICP resonant language across all marketing. Inputs: list of 8 to 12 ideal clients or prospects willing to do 30 minutes interviews. Interview script, 7 voice of customer questions. Marketing assets to rewrite. Homepage headline, ad copy, email sequence, sales script. Steps: day 1 to 20, 8 to 10 hours, total conduct 8 to 12 interviews, 30 minutes each. Record or take detailed notes. Transcribe key phrases. Highlight repeated language, emotional descriptors, and specific pain points. Day 21 to 30, 120 minutes, create language map. 3 columns, pain, desire, objection. Fill with verbatim phrases from interviews. Identify top 5 to 7 most repeated phrases. Day 31 to 45, 180 minutes, rewrite marketing assets using ICP language. Homepage headline, 1 ad, 1 email subject line, 1 sales script opener. Launch new copy. Day 46 to 90, 10 minutes daily, track CTR, CAC, inbound lead volume, and lead to close rate. Compare to baseline pre-rewrite metrics. Day 91 to 95, 90 minutes, analyze results. Calculate CTR lift percent, CAC reduction percent, lead quality improvement, measured by discovery to close rate. Document winning phrases for future use. Measurement. KPI, CTR, CAC, inbound lead volume, lead to close rate quality. Target. 40 to 120% CTR lift, 25 to 50% CAC reduction, 25 to 60% improvement in lead to close rate. Sample report. Baseline, 1.6% CTR, $580 CAC, 12% lead to close. Resonant copy, 3.8% CTR, $340 CAC, 28% lead to close. CTR lift, plus 138%. CAC drop, 41%. Quality lift, plus 133%. Stop/iterate rules. If interviews reveal no clear patterns, expand sample size to 15 to 20 clients or include lost prospects. Ask why they didn't buy. Reveals objection language. If new copy doesn't improve metrics by day 60, test alternative phrases or revisit interview data for stronger, more emotionally charged language. Repeat language mining every 90 days as market sophistication and ICP pain points evolve. Ethics note. Resonance is about clarity and connection, not manipulation. Use ICP. Language to help ideal customers self-select and feel understood, not to attract misaligned buyers with exaggerated claims. Chapter 8. Capital and Strategic Partnerships. The warm intro ladder that unlocks $1 million plus opportunities raising capital or landing transformational partnerships the traditional way. Cold emails, pitch decks to strangers, LinkedIn spam, has a 2 to 5% success rate and takes 6 to 18 months. The 7-figure approach uses a warm intro ladder, leveraging entangled relationships to reach high-value decision-makers through trusted referrals. Neuroscience shows that warm intros bypass skepticism, activate trust circuits in the brain, and increase response rates by 400 to 900%. The protocol. Map your network in 3 tiers. Tier 1. People you know well, past clients, close colleagues, advisors, friends. Tier 2. People 1 degree away, your Tier 1's networks. Tier 3. Target decision makers, investors, strategic partners, $100,000 plus clients, media contacts. The goal is to activate Tier 1 to introduce you to Tier 2, who introduce you to Tier 3. This is entanglement in action. Each node amplifies your reach exponentially without cold outreach. Most 6-figure entrepreneurs skip this because they assume their immediate network can't help. Wrong. Your Tier 1 knows someone who knows your Tier 3. The key is strategic asking. I'm looking to connect with specific role/company/investor type. Do you know anyone in that world or know someone who might? This opens pathways without demanding favors. The warm intro ladder. 4 rungs to $1 million plus opportunities. Rung 1. Network mapping, Tier 1, 2, 3 visualization. Open a spreadsheet. Column 1. Tier 1, 50 to 150 names. Everyone you know well. Column 2. Tier 2. Estimate their combined network reach. If each Tier 1 contact knows 200 people, your Tier 2 is 10,000 to 30,000. Column 3. Tier 3. Specific targets, names or roles of investors, partners, or clients you want to reach. Visually, this reveals connection potential you didn't know existed. Rung 2. The strategic ask, low pressure, high clarity. Choose 1 Tier 3 target. Review Tier 1 list. Who might know someone in that industry, role, or geography? Send a message. Hey, name. Hope you're well. Quick question. I'm looking to connect with a specific description, e.g., growth equity investors focus on B2B SaaS, or CMOs at $10 million to $50 million e-commerce companies. Do you know anyone in that space, or anyone who might? No worries if not. Just thought I'd ask. Send 8 to 12 Tier 1 contacts per target. Expect 20 to 40% response rate with at least 1 viable path. Rung 3. The value-first introduction. Make it easy to say yes. When someone offers an intro, reduce friction. Provide a 3-sentence forwardable blurb. This is your name. Name helps ICP achieve specific outcome in time frame. Name is looking to connect with Tier 3 target about specific reason, partnership, investment, collaboration. Worth a conversation. This takes 10 seconds to forward and increases follow-through by 60 to 80%. Rung 4. The gratitude loop, strengthen entanglement for future asks. After the intro, thank your Tier 1 contact immediately, publicly, LinkedIn post tagging them if appropriate, and privately, handwritten note, small thank you gift, or reciprocal intro. Update them on the outcome, met with Tier 3, exploring partnership. Thank you. This strengthens entanglement and makes them 5x more likely to help again. Micro story. Carlos's $1.2 million partnership from one LinkedIn message. Carlos ran a $900,000 per year software consultancy and wanted to partner with a major CRM platform to offer his services as a certified integration partner, projected to unlock $1 million plus annual revenue. He cold emailed the VP of Partnerships 3 times. No response. Then he reviewed his LinkedIn and saw a former client worked at that CRM company in sales. He messaged her, "Hey, Sarah, congrats on a new role. Quick question. I'm exploring a partnership with CRM. Do you know anyone on the partnerships team I could chat with?" No pressure. She responded in 2 hours. "Yes. Let me intro you to Mike, our VP of Partnerships." Carlos sent her a 3-sentence blurb. She forwarded it. Mike responded same day. 2 calls later, Carlos signed a partnership agreement projected to generate $1.2 million in year 1. Total effort: 1 warm ask, 1 forwardable blurb, 2 follow-up calls. Lesson: your network is deeper and more valuable than you think. Map it, activate it, leverage it. Protocol 8.1. The 60-day warm intro campaign, high-value opportunities. Objective: secure 5 to 8 warm intros to Tier 3 targets, investors, strategic partners, $100,000 plus clients, within 60 days using network mapping and strategic asks. Inputs: spreadsheet for network map 3 tiers. List of 3 to 5 Tier 3 targets, specific names, roles, or companies. 3-sentence blurb template for easy forwarding. Steps: Day 1 to 10, 180 minutes build network map. List 50 to 150 Tier 1 contacts, LinkedIn, email, phone contacts, past clients, colleagues, advisors. Identify 3 to 5 Tier 3 targets. Research: who are they? What do they care about? What's your value proposition? Day 11 to 30, 120 minutes for each Tier 3 target. Identify 8 to 12 Tier 1 contacts who might have a connection, industry overlap, geography, shared interests. Send strategic ask message. Track responses. Day 31 to 50, 90 minutes follow-up on positive responses. Provide easy forward 3-sentence blurb. Track intros made, emails forwarded, meetings scheduled. Day 51 to 60, 60 minutes send gratitude messages to everyone who helped, public plus private thank you. Log outcomes. Intros made, meetings held, deals/partnerships in progress. Measurement. KPI: number warm intros secured, meetings held with Tier 3 targets, partnerships, or deals in progress. Target: 5 to 8 intros, 3 to 5 meetings, 1 to 2 partnerships/deals in negotiation within 60 days. Sample report: reached out to 48 Tier 1 contacts across 4 targets. Secured 6 warm intros. Held 4 meetings. 1 partnership signed, $800,000 projected annual value. 1 investment conversation ongoing. Stop/iterate rules: if no intros by day 20, expand Tier 1 list or clarify target. Too vague equals fewer connections. If intros are made but meetings don't happen, improve blurb, add more specificity or value framing, or follow up faster. Repeat this protocol every 90 days to maintain momentum and expand network reach. Ethics note: warm intros work because of trust. Never abuse a connection by overpromising, being transactional, or spamming. Always reciprocate value and express genuine gratitude. Chapter 9, Measurement Mastery. The 1-page dashboard that drives $2 million plus decisions in quantum mechanics. Measurement collapses potential into reality. In 7-figure businesses, what you measure daily improves exponentially. Most entrepreneurs track revenue and expenses, but ignore the 7 operational levers that drive revenue. Close rate, ACV, CAC, LTV, referral velocity, revenue per hour, and pipeline conversion time. Without daily visibility into these metrics, you're flying blind, guessing at what works instead of knowing. The protocol: build a one-page dashboard showing your 7 core metrics, updated daily or weekly. This doesn't require fancy software, Google Sheets, Notion, Airtable, or even Paperworks. The act of logging numbers forces observation, which triggers pattern recognition, which leads to optimization. You notice, close rate dropped 12% this week. What changed? Answer: you skip pre-call priming 3 times. Fix: recommit to priming. Result: close rate rebounds within 7 days. 7-figure entrepreneurs don't make decisions based on gut feel or hope. They make decisions based on dashboard-driven insights that reveal which lever, if pulled, will unlock the next $200,000 to $500,000 in revenue. The 7 metrics every 7-figure dashboard must track: close rate, high-ticket deals won divided by qualified opportunities on offers $25,000 plus. Target: 35 to 55%. Average contract value, ACV total revenue, divided by number of deals. Track by tier. Target: $40,000 to $100,000 plus for 7 figures. CAC, customer acquisition cost, total marketing plus sales spend divided by new customers. Target: LTV 8, 12x CAC. LTV, lifetime value average customer spend times retention period plus referral value. Track cohorts quarterly. Target: $150,000 to $500,000 plus for high ticket. Referral velocity, warm intros received divided by clients closed, measured over 90 days. Target: 1.5 to 3 referrals per client. Revenue per hour, monthly revenue divided by total work hours, or deep work hours for more accurate leverage measure. Target: $600 to $1,500 per hour for 7 figures. Pipeline conversion time, average days from first contact to close. Faster velocity equals more revenue per quarter. Target: 30 to 60 days for high ticket. The optimization loop: measure, analyze, hypothesize, test. Measure again. This is a scientific method applied to business growth. No guessing, no hope marketing, just disciplined experimentation and data-driven iteration. Example: you notice ACV drop from $52,000 to $44,000 over 4 weeks. You hypothesize, we're closing smaller deals because we're not positioning premium tier well. You test, revise sales script to anchor premium tier first, then present core tier. You measure, ACV rebounds to $51,000 within 3 weeks. You document the insight and train the team. Micro story: Sophia's $840,000 annual lift from one dashboard inside Sophia ran a $1.4 million per year consultancy. She built a dashboard tracking her 7 metrics weekly. Week 5, she noticed her close rate was 52% on Tuesday/Wednesday calls, but only 24% on Monday/Friday calls. She hypothesized, Monday calls catch prospects overwhelmed from a weekend. Friday calls catch them mentally checked out. She moved all high-ticket discovery calls to Tuesday through Thursday. Within 60 days, her overall close rate jumped from 38% to 49%. At $60,000 average deal size and 24 opportunities/quarter, that's plus 2.6 extra closes per quarter, equals $156,000 quarterly lift equals $624,000 annualized. But the compounding effect was bigger. Higher close rate freed 8 hours per week previously spent on dead-end calls, which she reinvested into strategic partnerships, generating another $216,000 in referred revenue. Total annual impact from one scheduling insight, revealed by measurement, $840,000 plus. Lesson: the data is already there. You just need to look at it consistently. Protocol 9.1. The 90-day measurement system install, dashboard plus optimization loop, objective. Build and maintain a one-page dashboard tracking 7 core metrics weekly, lead to 2 to 3 optimization insights per quarter that increase revenue by 15 to 40%. Inputs: Google Sheets, Notion, Airtable, or Excel. last 12 weeks of sales and operational data, or start from week 1 if unavailable. 20 minutes per week for data entry and review. Steps: day 1 to 5, 120 minutes build dashboard template. 7 columns: week, close rate percent, ACV dollar, CAC dollar, LTV dollar, referral velocity ratio, revenue/hour dollar, pipeline days. Add simple line charts for each metric. If historical data exists, backfill last 12 weeks. Week 1 to 12, 20 minutes weekly every Monday morning. Log last week's 7 metrics. Review trends. Ask, what's surprising? What changed? What pattern do I see? Write 1 observation per week. Week 4, 8, 12, 45 minutes each deep review. Identify 1 pattern or anomaly. Form hypothesis. Design 1-week test. Example: close rate high on Wednesdays. Test scheduling all calls Tuesday through Thursday. Document hypothesis, test, and result. Day 90. 90 minutes compare week 1 versus week 12 metrics. Calculate improvement across all 7. Identify top 2 to 3 insights that drove measurable results. Document in a playbook for future reference and team training. Measurement. KPI, number of optimization insights discovered and tested, revenue impact per insight. Target, 2 to 3 insights over 90 days, with at least 1 leading to 15 to 40% revenue lift in that lever. Sample report. Week 1, 34% close rate, $48,000 ACV, $620 CAC, 1.2 referral velocity. Week 12, 46% close rate, $54,000 ACV, $480 CAC, 2.1 referral velocity. Insight 1. Move calls to Tuesday through Thursday, plus 12 points close rate. Insight 2. Revise partner ask script, plus 75% referral velocity. Insight 3. Raise pricing by $6,000, ACV plus 12.5%. Combined revenue impact, plus $680K annualized. Stop/iterate rules. If no insights emerge by week 6, data may be incomplete or you're not asking why. Enough? Expand tracking or add qualitative notes, e.g., lost deal, reason, pricing too high, competitor offered faster timeline. If dashboard feels overwhelming, start with 4 metrics: close rate, ACV, CAC, referral velocity, and add others after 30 days. Revisit dashboard design every 90 days. Add metrics that reveal leverage. Remove vanity metrics. Ethics note. Measurement reveals truth, but doesn't manufacture results. Use data to guide decisions, not to justify poor offers or unethical tactics. If metrics show your offer isn't working, fix the offer. Don't manipulate the data. Chapter 10. Revenue stacking architecture, upsells, downsells, and ascension paths to $2 million plus. Most 6-figure entrepreneurs have 1 offer at 1 price. 7-figure operators have revenue stacking systems, a strategic architecture of entry offers, core offers, premium tiers, upsells, and ascension paths that maximize customer lifetime value and create multiple revenue streams from the same client relationship. The quantum principle here is superposition applied to offer design. Instead of forcing every prospect into 1 offer at 1 price, you create multiple pathways: low-ticket entry, mid-ticket core, high-ticket premium, and let the prospect collapse into the tier that matches their budget, urgency, and sophistication. This increases total addressable market without diluting positioning. The 7-figure revenue stack typically has 3 tiers plus. 2 levers. Tier 1, entry offer, $1,000 to $5,000. Low friction, fast close, self-serve, or light touch. Example: diagnostic audit, strategy session, mini course. Purpose: attract prospects not ready for $50,000, build trust, upsell 30 to 50% to Tier 2 within 90 days. Tier 2, core offer, $15,000 to $50,000, your primary revenue driver. Most clients start here. Example: done-for-you implementation, 6-month engagement, full service package. Tier 3, premium offer, $75,000 to $200,000 plus, for clients who want VIP access, faster timelines, or ongoing support. Example: retainer, white glove service, equity partnership. Level 1, upsells. After delivering Tier 1 or 2, offer logical next step. Example, Tier 1 client completes audit upsell to Tier 2 implementation. Tier 2 client finishes 6-month project upsell to Tier 3 retainer. Lever 2, downsells. If prospect can afford Tier 2, offer Tier 1 instead of losing them. Capture $3,000 today, nurture, upsell to $30,000 in 6 months. Revenue stacking doesn't mean offering everything to everyone. It means designing intentional pathways that let clients start where they're ready and ascend as value is proven. Micro story. Mia's $1.9 million year. By adding 2 tiers to 1, offer Mia ran a $720,000 per year coaching business with 1 offer. $24,000 year-long coaching program. She closed 30 clients/year. But she lost 40-plus qualified prospects annually who said, "I'm not ready for $24,000 yet," or "I need something faster and deeper." She added 2 tiers. Tier 1, $3,000, 6-week intensive with group support. And Tier 3, $60,000, private quarterly retreats plus ongoing Voxer access. Year 1 results. 22 Tier 1 clients, $66,000 revenue. 9 upsold to Tier 2 within 6 months equals $216,000 additional. 24 Tier 2 clients, $576,000, consistent with prior year. 5 Tier 3 clients, $300,000, all upsold from Tier 2 after proving results. She also added a $12,000 upsell, 3-month continuation for Tier 2 grads. 14 clients took it, $168,000. Total revenue, $66,000 plus $576,000 plus $300,000 plus $168,000 plus residual equals $1.9 million. She didn't work more hours. She didn't find new clients. She simply created pathways for existing demand to convert at multiple price points. Lesson: revenue stacking turns not yet into yes at this tier. Protocol 10.1. The 90-day revenue stack build objective. Design and launch a 3-tier offer stack plus 1 upsell within 90 days, increasing total revenue by 25 to 60% without acquiring more leads. Inputs: your current core offer, pricing, deliverables, timeline. List of objections from lost deals in last 12 months. Too expensive, not ready. Need faster results. Estimate of annual lost opportunity. Prospects who said no, but were qualified. Steps: Day 1 to 15, 6 hours design Tier 1 entry. What can you offer for $1,000 to $5,000 that delivers quick value, builds trust, and naturally leads to your core offer? Example, audit workshop mini program. Price it. Outline deliverables. Create simple sales page or PDF. Day 16 to 30, 6 hours design Tier 3 premium. What can you offer for $75,000 to $200,000 plus that provides more speed, access, or results in your core offer? Example, retainer, VIP days, equity deal. Outline scope, price, positioning. Day 31 to 45, 4 hours design 1 upsell. What's the logical next step after Tier 1 or Tier 2? Example, Tier 1 grads, Tier 2 implementation. Tier 2 grads, 3-month extension, or Tier 3 retainer. Create offer plus script. Day 46 to 60, launch soft launch Tier 1 to existing email list or past prospects who said not ready. Offer Tier 3 to your top 5 current or recent clients. Test messaging and pricing. Day 61 to 90, track log conversions per tier. Track. Tier 1 conversions, Tier 1, Tier 2 upsell rate. Tier 3 conversions, total revenue added. Measurement. KPI, revenue per tier, upsell conversion rate. Tier 1, Tier 2, Tier 2, Tier 3. Target. 25 to 60% total revenue increase within 90 days from stack architecture. Sample report. Tier 1 18 clients, $54,000. Tier 2 20 clients, $480,000. Tier 3, for clients, $280,000. Upsells, 8, Tier 1, Tier 2, $192,000. Total revenue lift, plus $1.006 M versus prior same 90 days, $580,000. Lift, plus 73%. Stop/iterate rules. If Tier 1 doesn't convert, price may be too high or value unclear, revise offer or positioning. If Tier 3 doesn't sell, you may not have proven enough value at Tier 2 yet. Wait 6 months, deliver results, then reoffer. If upsells don't convert, timing may be off, ask too early, or offer isn't logical next step. Revise pathway. Ethics note: revenue stacking serves clients by meeting them where they are. It's not about squeezing every dollar. It's about providing multiple entry and growth paths so more people get help at the level they're ready for. Chapter 11, Team Leverage and Delegation. Without losing quantum coherence, one of the biggest barriers to 7 figures is the false belief that I have to do everything myself to maintain quality. This is Newtonian thinking, linear, time-bound, unsustainable. 7-figure operators think quantum, leverage through delegation while maintaining coherence by systematizing decision-making, building playbooks, and hiring for alignment, not just skills. The challenge: most entrepreneurs hire too late, burnout forces it, or hire wrong, skills without cultural fit. Then they spend 20 hours per week managing the hire, negating all leverage. The quantum approach is different. Hire to protect your deep work coherence, not to offload tasks. You identify the 20% of your work that generates 80% of revenue, sales, strategy, partnerships, then hire to eliminate or systematize the other 80%, operations, admin, delivery, execution. The protocol: delegate to amplify, not to abdicate. You don't hand off everything and disappear. You build systems, SOPs, playbooks, decision frameworks. Hire people aligned with your mission and standards. Train them to operate within those systems. Then audit weekly until they're autonomous. This typically takes 90 to 180 days per key hire, but once operational, each team member can free 10 to 25 hours/week of your time. The 4-layer team leverage system for 7-figure coherence. Layer 1. The 80/20 audit. Identify what to delegate first. Track your time for 2 weeks. Categorize every hour: revenue generating, sales, strategy, client delivery, enabling operations, admin coordination, reactive, firefighting, low-value tasks. Calculate: what percent of your time is revenue generating? If under 50%, you need delegation. Identify the top 3 to 5 enabling or reactive tasks consuming the most hours. These are your first delegation targets. Layer 2. Systematize before you delegate. Build a playbook. Before hiring, document how you currently do the task. Record a Loom video. Write a checklist. Create a template. Example: client onboarding SOP. Step 1. Send welcome email. Template attached. Step 2. Schedule kickoff. Calendar link. Step 3. Send pre-call questionnaire. This playbook ensures a hire can replicate your quality without reinventing the process. Layer 3. Hire for alignment plus skill, culture fit resume. 7-figure operators hire people who align with their mission, values, and standards first, skills second. Skills can be trained. Misalignment kills teams. Ask in interviews: what's a project you're proud of and why? How do you handle ambiguity? What do you do when you don't know the answer? Look for ownership, curiosity, and proactive problem solving, not just credentials. Layer 4. Train, audit, automate. The 90-day ramp, week 1 to 4. Train intensively. Shadow you. Watch Loom videos. Execute tasks with your review. Week 5 to 8. Execute independently with weekly check-ins. Week 9 to 12. Audit monthly. Trust autonomy. By day 90, they should handle the function with 90% independence. If not, either the system needs refinement or the hire isn't the right fit. Micro story: Ahmed's $400,000 timer claim, by hiring a COO, Ahmed ran a $1.1 million per year consultancy and worked 58 hours per week. He tracked his time: 18 hours on sales/strategy, revenue generating, 40 hours on client delivery, team coordination, and admin, enabling/reactive. He was a bottleneck. He hired a COO for $90,000 per year to own operations, client delivery coordination, and team management. First 60 days were painful. Ahmed spent 15 hours per week training, documenting SOPs, and auditing. But by day 90, the COO was autonomous. Ahmed reclaimed 28 hours per week. He reinvested 20 of those into sales and partnerships. Within 6 months, he closed $640,000 in new deals, his highest 6-month period ever, because he finally had time to focus on revenue. The COO hire cost $90,000. The revenue unlocked was $640,000. ROI, 7.1x in year 1. Lesson: the right hire doesn't cost you. It multiplies you. Protocol 11.1. The 90-day first key hire. Reclaim 15 to 25 hours/week. Objective: hire and train one key team member within 90 days to reclaim 15 to 25 hours/week of your time for revenue-generating deep work. Inputs: 2-week time audit. Categorize every hour. Revenue-generating. Enabling reactive. List of top 3 to 5 tasks consuming most non-revenue time. Budget for hire, salary, contractor fee, or VA costs. Steps: day 1 to 14, 6 hours complete time audit. Identify delegation target. Which role would free the most hours? Common first hires: executive assistant, operator/OO, lead SDR, project manager. Day 15 to 21, 4 hours right role description. Include responsibilities, KPIs, required skills, cultural fit criteria. Post on job boards. Ask network for referrals. Day 22 to 35, 8 hours interview 5 to 10 candidates. Ask alignment plus ownership questions. Check references. Make offer. Day 36 to 65, 30 hours total. 10 hours per week on board and train. Week 1 to 2, shadow you. Week 3 to 4, execute with your review. Record SOPs as you go. Loom videos, checklists. Day 66 to 90, 5 hours total audit weekly. By day 90, hire should operate 85 to 90% independently. Day 91, 60 minutes audit time reclaimed. Calculate hours freed per week, revenue impact. Did you close more deals or focus more on strategy? Measurement. KPI, hours reclaimed per week, revenue impact within 90 days post-hire. Target, reclaim 15 to 25 hours/week. Reinvest into revenue-generating work. Close $100,000 to $300,000 plus additional revenue within 6 months. Sample report. Pre-hire, 58 hours per week, 18 revenue-generating. Post-hire, day 90, 45 hours per week, 35 revenue-generating. Hours reclaimed, 22/week. Revenue impact, 6 months plus $420K from freed sales time. Higher cost, $45,000, 6 months. ROI 9.3x. Stop/iterate rules. If hire isn't autonomous by day 90, assess. Is training insufficient? Is hire wrong fit? Revise SOPs or consider replacement. If hours aren't reclaimed, you may be micromanaging. Audit your delegation style and trust level. Ethics note: delegation is about empowering others, not exploiting them. Pay fair wages. Provide clear expectations and create growth paths. Leverage should benefit both you and your team. If this protocol clarified your millionaire business focus, subscribe to receive new practical playbooks. Chapter 12. Client Retention and LTV Maximization. Turning $50,000 clients into $200,000 plus lifetime relationships. Most entrepreneurs obsess over acquisition and ignore retention. This is expensive and exhausting. 7-figure operators know that increasing client LTV by 40 to 80% is 10x easier than acquiring new clients at the same rate. The math is simple. If your average client spends $50,000 over 12 months, increasing retention to 24 months doubles LTV to $100,000 without acquiring a single new lead. The quantum principle, entanglement through value delivery. When you over-deliver, clients don't just stay, they become entangled in your ecosystem. They renew, they upsell, they refer, they become case studies. One high LTV client, $200,000 plus lifetime spend. is worth 21 times $10,000 clients in terms of profit, referrals, and operational simplicity. The 7-figure retention system has 3 components. Proactive check-ins, don't wait for problems. Solve them before clients notice. Milestone celebrations, recognize wins together. It builds emotional loyalty. And logical ascension offers, when they get results, offer the next level before they think to leave. The 3 retention levers at double LTV. Lever 1. The 30/60/90 day proactive check-in system. Most client churn happens because of silent dissatisfaction. They don't complain. They just don't renew. 7-figure operators prevent this with scheduled check-ins. At day 30, 60, and 90 of every engagement, you or your account manager reach out. How's it going? Are we on track? What's one thing we could improve? This surfaces issues early, shows you care, and increases renewal rates by 30 to 50%. Lever 2. Milestone celebrations, dopamine plus loyalty. Neuroscience shows that celebrating wins releases dopamine and strengthens positive associations. When a client hits a milestone, first $100,000 month, 50% churn reduction, successful product launch, send a handwritten note, small gift, or public shout-out with permission. This costs $20 to $50, but creates emotional loyalty worth $50,000 to $200,000 in renewals and referrals. Lever 3. The Ascension offer, strike, while trust is high. The best time to upsell is immediately after delivering a win. When a Tier 2 client achieved their goal, e.g., you help them add $500,000 revenue in 6 months, present the Tier 3 offer. Congrats on the $500,000 lift. Want to go for a $2 million next year? Here's how. Trust is highest. ROI is proven. Objections are minimal. Conversion rates on post-success upsells, 40 to 65%. Micro story. Elena's $1.4 million LTV increase by fixing one retention gap. Elena ran a $980,000 per year branding agency. Average client LTV, $32,000, one 6-month project, then they left. She analyzed why clients didn't renew and found the gap. After delivering the rebrand, she sent a final invoice and disappeared. No follow-up, no check-in, no next. Offer. Clients assumed the relationship was over. She installed a proactive check-in system. At project month 4 before completion, she'd say, once we finish this rebrand, the next logical step is ongoing brand management, maintaining consistency, creating content, evolving messaging. Want to talk about a 12-month retainer? 60% said yes. She also added milestone celebrations. When a client's rebrand launched, she sent a custom frame print of their new logo with a note. Clients posted it on social media, tagged her, referred friends. Within 12 months, average LTV jumped from $32,000 to $87,000. Projects plus retainers plus referrals. Total LTV increased across 16 clients, $880,000. She added 6 new clients through referrals, another $192,000. Total impact, $1.072 million incremental revenue from retention improvements alone. Lesson: the easiest revenue is in the clients you already have. Protocol 12.1. The 90-day client retention system install objective. Increase average client LTV by 30 to 60% within 90 days by installing proactive check-ins, milestone celebrations, and ascension offers. Inputs: list of current and recent clients, last 12 months. Average client LTV baseline, total revenue per client divided by number of clients. Calendar for scheduling check-ins. Steps: day 1 to 10, 90 minutes, calculate baseline LTV. Review recent client exits. Why did they leave? Was there a natural end, or did you fail to offer next step? Day 11 to 30, 60 minutes, install 30/60/90 check-in system. For all active clients, schedule check-ins at 30, 60, 90 days. Use script. How's everything? Are we on track? What can we improve? Log feedback and act on it. Day 31 to 60, 90 minutes, add milestone celebrations. Identify 3 to 5 client wins happening in next 60 days. Launch, revenue milestone completion. Send handwritten note plus small gift, $20 to $50. Track client response and referrals generated. Days 61 to 90, 100, 20 minutes present ascension offers. For clients nearing project completion or achieving major wins, present next level offer, retainer, phase 2, advanced tier. Track conversion rate. Day 91, 60 minutes measure LTV change. Compare. Clients who received check-ins plus celebrations plus ascension offers versus clients who didn't. Calculate LTV lift. Measurement. KPI. Average client LTV, renewal rate, upsell conversion rate. Target. 30 to 60% LTV increase within 90 days. Sample report. Baseline LTV, $34,000. Post-system LTV, $52,000. Lift, plus 53%. Renewal rate, 42%, 68%. Upsell conversion. Ascension offers 58%. Total incremental revenue, 12 clients plus $216K. Stop/iterate rules. If LTV doesn't increase, audit. Are check-ins happening consistently? Are you actually listening and acting on feedback? Are ascension offers presented at the right time, post-win, not mid-struggle? If clients don't respond to celebrations, personalized more, generic gifts feel transactional. Specific, thoughtful gifts feel genuine. Ethics note. Retention tactics should serve the client, not trap them. Only upsell when it genuinely helps them achieve more. Never guilt clients into staying or renewing. Chapter 13. Scaling systems and automation without losing quantum edge, the seven-figure paradox. To scale past $1 million, you need systems and automation, but too much systematization kills the quantum edge, presence, intuition, personalization that made you successful in the first place. Most entrepreneurs solve this by over-systemizing, turning their business into a soulless machine. Revenue plateaus because clients feel the difference. The quantum solution: systematize the repeatable, protect the irreplaceable, automate low-value tasks, scheduling, invoicing, email sequences, reporting. Systematize medium-value tasks, onboarding, delivery workflows, check-ins. But protect high-value tasks, sales calls, strategic decisions, client breakthroughs, as human-driven, presence-based, and personalized. Seven-figure operators use the 70/20/10 rule. 70% of business operations are fully systematized, SOPs, automation, templates. 20% are semi-systematized, frameworks with room for customization. And 10% remain fully intuitive and human, high-touch client moments, strategic pivots, creative breakthroughs. This balance allows scale without sacrificing soul. The 4-layer scaling system for quantum coherent growth. Layer 1. Automate the invisible, tech stack optimization. Identify every task that's repetitive and low judgment. Scheduling, use Calendly. Invoicing, use Stripe/PayPal auto billing. Email follow-ups, use sequences in HubSpot/ActiveCampaign. Reporting, use Zapier plus Google Sheets auto population. These tasks don't need you. Automate them completely. This typically frees 5 to 10 hours/week. Layer 2. Systematize delivery, SOPs plus templates. Create playbooks for repeatable client work. Onboarding checklists, project templates, common deliverable frameworks. Example: if you deliver brand strategy, create a template deck with sections: discovery, positioning, messaging, visual identity. Customize per client, but don't reinvent the wheel. This ensures consistency and speeds delivery by 30 to 50%. Layer 3. Protect the irreplaceable. Reserve deep work time for high touch. Never automate or delegate. High-ticket sales calls, strategic client sessions, creative breakthroughs, partnership negotiations. These are where your unique presence, intuition, and expertise create disproportionate value. Block 10 to 15 hours/week for these activities. Untouchable, non-delegable. Layer 4. Audit quarterly, the soul check. Every 90 days, ask, does this business still feel aligned? Are we over-systemized, clients feel like numbers, or under-systemized, chaos and burnout? Adjust a 70/20/10 balance. If client feedback mentions it feels impersonal, reduce automation and client touchpoints. If team is overwhelmed, systematize more delivery. Microstory. Ryan's $2.3 million scale. Without losing client intimacy, Ryan ran a $1.1 million leadership coaching business. To scale past $2 million, he knew he needed systems, but he feared losing the personal touch clients loved. He applied the 70/20/10 rule. He automated scheduling, Calendly, payment, Stripe subscriptions, onboarding email sequence, CRM updates, Zapier. He systematized coaching session frameworks, agenda templates, client progress dashboards, automated tracking, quarterly check-ins, templated but personalized. He protected all one-on-one coaching calls, 100% human, no scripts, strategy breakthroughs, intuitive in the moment, and milestone celebrations, handwritten notes. Result: he scaled from 22 to 38 clients without hiring more coaches. Systematized delivery allowed him to coach more efficiently. Revenue hit $2.3 million. Client NPS satisfaction stayed at September 2nd, 10, same as when he had 12 clients. Lesson: systemize the scale, but never systematize the magic. Protocol 13.1. The 90-day scaling system audit and build objective. Free 8 to 15 hours/week through automation and systematization, while protecting high-value, human-driven work, enabling scale from $1 million to $2 million plus without losing quantum edge. Inputs: 2-week time audit, categorize, automate able, systematize able, irreplaceable. List of current tech stack and tools. Client feedback, NPS, testimonial, complaints to assess soul of business. Steps: Day 1 to 14, 6 hours, audit all tasks. Categorize, automate repetitive, low judgment. Systematize, repeatable but needs customization. Protect unique, high value, human. Identify top 5 to 7 tasks in each category. Day 15 to 40, 10 hours, automate top 3 tasks. Examples: scheduling tool, billing automation, email sequences. Implement and test. Day 41 to 65, 12 hours, systematize top 3 tasks. Create SOPs, templates, checklists. Train team, if applicable, or document for your own use. Day 66 to 80, 2 hours, audit time saved. Measure: hours free per week, client feedback. Has quality changed? Day 81 to 90, 90 minutes quarterly soul check. Ask clients: how's our service feeling? Any feedback? Review NPS or testimonials. Adjust 70/20/10 balance if needed. Measurement: KPI, hours free per week, client satisfaction, NPS. Revenue capacity: can you serve more clients without quality drop? Target: free 8 to 15 hours/week, maintain or improve NPS. Increase client capacity by 20 to 40%. Sample report: pre-system, 52 hours per week, 22 clients, NPS 8.9. Post-system, 44 hours per week, 34 clients, NPS 9.1. Hours freed, 8/week. Client capacity, plus 54%. Revenue, $1.1 million, $1.9 million. Quality, improved. Stop/iterate rules. If client satisfaction drops, NPS declines. You over-automated, rehumanize key touchpoints. If time isn't freed, you're not automating enough or delegation is incomplete. Repeat audit every 90 days as business scales. Ethics note: automation serve efficiency, not dehumanization. Never automate client relationships to the point where they feel like transactions. Scale with soul. Chapter 14. Advanced negotiation, objection handling, and premium pricing authority. At the 7-figure level, objections aren't rejections. They're buying signals wrapped in doubt. When a $100,000 prospect says that's expensive, they're not saying no. They're saying, convince me this is worth it. 7-figure closers don't defend price. They reframe value, anchor ROI, and use objections as opportunities to deepen discovery. The quantum principle: uncertainty is natural in high-stakes decisions. Your job isn't to eliminate uncertainty, impossible. Your job is to help the prospect collapse uncertainty into clarity by guiding them to articulate their own reasons for saying yes. The protocol: The 3-layer objection architecture: acknowledge, explore, reframe. This takes 90 to 180 seconds and converts 40 to 60% of objections into closes. The 3-layer objection response system: layer 1, acknowledge without agreeing, validate the feeling. When a prospect says that's expensive, never say no it's not, or you get what you pay for, defensive, dismissive. Instead, I understand $100K is a significant investment. Can I ask what you're comparing it to? This validates their concern, keeps the door open, and invites exploration. Layer 2, explore the underlying concern, uncover the real objection. Expensive is rarely the real objection. It's usually, I'm not sure this will work, or I don't have budget approval, or I'm scared of making the wrong decision. Ask, when you say expensive, what specifically are you concerned about? Is it budget, ROI, timing, or something else? Listen, let them reveal the true hesitation. Now you can address the real issue, not the surface one. Layer 3, reframe with ROI plus social proof plus urgency. Once you know the real concern, reframe. Example, concern, ROI, I get it, $100K is significant. Here's the context. This solves your $1.2 million per year problem, so it's about 8% of annual value. We've done this for 14 companies your size, and the average ROI is 11x in year 1. Does that shift how you're thinking about it? Concern, budget. Understood. Is it that budget doesn't exist, or that it's allocated elsewhere? Uncover truth. If allocated, would it make sense to reallocate from lower ROI initiative, given this could unlock $1.2 million? If doesn't exist, what if we structured payment over 6 months? Does that make it feasible? Concern, fear of failure. That's fair, you want certainty. Here's what we do. 30-day proof of concept phase with clear milestones. If we don't hit them, we pause and reassess. Does that reduce the risk enough to move forward? This 3-layer system doesn't overcome objections combative. It collaboratively resolves concerns, partnership. The premium pricing authority frames 7-figure. Entrepreneurs don't compete on price. They compete on outcome certainty and speed. When pricing comes up, they say, our investment is $100,000. Here's why. We solve problem in time frame with specific outcome. Our clients typically see ROI multiple return in time frame. We don't offer discounts because we don't cut corners. Every dollar goes into delivering that result. Does that make sense given what's at stake for you? This positions price as a reflection of value, not a negotiation point. If a prospect pushes for a discount, 7-figure operators offer value trade-offs, not price cuts. I can't reduce the investment without reducing scope. If budget is the issue, we could remove component, which brings it to $75,000. But you lose outcome. Does that trade-off work? Or would you rather get the full result? This reframes discounting as a loss, not a win. Micro story. Tara's $120,000 close after handling too expensive objection. Tara sold enterprise sales training. A prospect, VP of sales at a $40 million company, said, I love the program, but $120,000 is steep. Old Tara would have panicked and offered a discount. New Tara used a 3-layer system. Acknowledge. I understand $120K is significant. What are you comparing it to? Prospect. We spent $60,000 on a training program last year and saw 0 results. Explore. Got it. So it's not the dollar amount. It's whether this will actually work, right? Prospect. Exactly. Reframe. Fair. Here's the difference. That program was generic. Ours is custom to your ICP, your objections, your sales cycle. We've done this for 9 companies your size. Average lift is 38% in close rate within 90 days. For your team of 12 reps averaging $800,000 per year each, a 38% lift is $3.6 million additional revenue. $120,000 is 3.3% of that. Does that context help? Prospect paused and said, yes, let's do it. Deal closed same week. Lesson. Objections are opportunities to deepen value understanding, not reasons to retreat. Protocol 14.1. The 60-day Advanced Objection Mastery System objective. Increase close rate on objection-heavy calls by 15 to 30 percentage points within 60 days by mastering the 3-layer objection architecture and premium pricing authority frame. Inputs. List the top 5 objections you hear most often. Too expensive, need to think about it, not the right time, need to check with partner, etc. 3-layer response script for each objection. Acknowledge, explore, reframe. Recording tool for calls, Zoom Gong, to review and improve. Steps. Day 1 to 7, 90 minutes, list your top 5 objections. For each, write 3-layer response. Acknowledge, validating phrase. Explore, question to uncover real concern. Reframe, ROI/proof/urgency statement. Practice aloud 5 times per objection. Day 8 to 60 per call. 5 minutes prep before every discovery/close call. Review your objection scripts. During call, when objection arises, use 3-layer system. Don't rush. Let layers breathe. Acknowledge, pause, explore, listen, reframe. Track. Did objection convert to close? Y/N. Day 30, 60 minutes midpoint review. Listen to 3 recorded calls where you handled objections. Grade yourself. Did you acknowledge without defending? Did you explore the real concern? Did you reframe with ROI/proof? Adjust scripts based on what worked. Day 61, 90 minutes, analyze 60 days of calls. Calculate. Close rate on calls with objections using 3-layer versus baseline old objection handling. Document improvement. Measurement. KPI. Close rate on objection-heavy calls. Average time from objection to close. Target. 15 to 30 percentage point increase in close rate when objections arise. Sample report. Baseline. Old objection handling, 22% close when too expensive objection arose. 3-layer handling. 51% close. Lift plus 29 points. Sample size. 34 calls with pricing objection. Stop/iterate rules. If objections still kill deals, record calls and audit. Are you getting offensive? Are you skipping explore, the most critical layer? Are you reframing with data or just opinion? If reframe isn't landing, strengthen proof. Add case studies, testimonials, specific ROI numbers. Revisit scripts every 90 days as objections evolve. Ethics note. Objection handling is about clarity, not manipulation. If the prospect genuinely isn't a fit, wrong budget, wrong timing, wrong need, help them say no. Forcing a close when fit doesn't exist damages both parties. Chapter 15. The 30-Day Protocol and 12-Month Scaling Roadmap. Your complete path to $2 million, plus you now have the complete quantum selectivity system for 7-figure growth. Baseline observation, observer effect presence, superposition pricing, entanglement referrals, coherence rituals, negotiation neuroscience, marketing resonance, strategic partnerships, measurement mastery, revenue stacking, team leverage, retention optimization, scaling systems, and advanced objection handling. The question is, how do you deploy all 14 levers in a structured, sustainable sequence without overwhelm? The answer, the 30-day quantum sprint plus 12-month scaling roadmap. This is a phased implementation where you install 1 quantum lever per week for 4 weeks, then enter a 12-month scaling cycle with quarterly deep dives, monthly optimization sprints, and weekly measurement rituals. Most entrepreneurs who follow this protocol see 30 to 60% revenue growth in quarter 1, 2x within 9 to 12 months, and sustainable 7-figure scale by month 18 to 24. The 30-day quantum sprint. Week by week install week 1. Foundation plus baseline quantum selectivity diagnostic. Day 1 to 2. Baseline audit, protocol 1.1. Calculate your 7 core metrics. Identify your highest leverage offer tier, highest revenue/hour plus LTV, CAC. Day 3 to 7. Install observer effect priming ritual, protocol 2.1. Prime 20 minutes before every high-ticket call. Track close rate daily. Week 2. Pricing plus entanglement day 8 to 10. Design superposition pricing test, protocol 3.1. Create 2 variants, $27,000 versus $30,000 or similar. Set up split assignment. Day 11 to 14, launch pricing test. Simultaneously, conduct 3 referral exit interviews. Protocol 4.1 partial. Ask for warm intros. Log referrals received. Week 3. Coherence plus Partnerships Day 15 to 17. Install morning coherence routine, Protocol 5.1 partial. Protect first 120 minutes for deep work. No phone until 9 a.m. Day 18 to 21. Reach out to 5 strategic partners, Protocol 8.1 partial. Led with value. Send 1 warm intro immediately. Track partner responses. Week 4. Measurement plus Retention Day 22 to 24. Build 1-page dashboard, Protocol 9.1 partial. 7 metrics. Simple line charts. Backfill 4 weeks of data. Day 25 to 28. Install 30/60/90 client check-in system. Protocol 12.1 partial. Schedule check-ins for all active clients. Day 29 to 30. Sprint review. Compare week 1 baseline to week 4 current state. Calculate improvements. Close rate, referrals received, deep work hours. Pricing test early results. Identify top 2 wins and top 2 friction points. Plan next 30-day cycle. The 12-month scaling roadmap months 1 to 3. Refine and compound continue all Sprint 1 protocols. Add ICP language mining, Protocol 7.1. 5 yes negotiation, Protocol 6.1. Run 60-day pricing test to completion. Analyze and implement winning variant. Goal: 30 to 50% revenue lift from baseline. Months 4 to 6, team and revenue stack higher first key team member. Protocol 11.1. To reclaim 15 to 25 hours/week. Build 3-tier revenue stack. Protocol 10.1 entry. $3,000 to $5,000. Core, $25,000 to $50,000. Premium, $75,000 to $150,000. Launch entry tier to warm list. Offer premium to top clients. Goal: increase client capacity by 30%, total revenue by 50 to 80%. Months 7 to 9, scale systems and partnerships, install scaling systems. Protocol 13.1 automate scheduling/billing. Systematize delivery with SOPs. Launch warm intro campaign. Protocol 8.1. Full 60-day target 5 to 8 strategic intros. Goal: free 10+ hours/week through systems. Close 1 to 2 major partnerships worth $200,000 to $500,000 plus annual value. Months 10 to 12, advanced optimization and breakthrough master advanced objection handling. Protocol 14.1. Optimize top-performing marketing channel using resonance language. Run quarterly dashboard deep dive. Identify 1 hidden lever, e.g., Friday calls convert 40% lower. Reschedule all to Tuesday through Thursday. Goal: hit $1.5 million to $2 million plus annual run rate. Maintain 30 to 40 focus work hours/week. Achieve 50% plus profit margin through leverage and retention. Post 12 months. Systematize and lead document all protocols in a master playbook. Train team to run systems autonomously. Shift your role from operator to strategic leader. Focus 80% time on sales, partnerships, vision, and creative breakthroughs. Hire SOO or integrator to run operations. Goal: scale past $2 million toward $3 million to $5 million while working 25 to 30 hours/week. Micro story: Jordan's $240,000 to $2.1 million in 14 months. Using the full roadmap, Jordan ran a $240,000 per year consulting practice. Stuck and exhausted. He implemented the 30-day sprint, audited metrics, installed priming, tested pricing. $22,000, $25,000, 1. Built dashboard, activated referrals. Month 1 revenue, $28,000, 17% up. He continued, added ICP language to ads, CTR doubled. Hired a VA to free 12 hours per week. Built 3-tier stack, $5K/$25K/$60K. Month 6 revenue, $62,000 per month average, $744,000 annual run rate. He hired a COO, systematized delivery, launched warm intro campaign, Landed 2 strategic partners worth $380,000 combined annual pipeline. Month 12 revenue, $142,000 per month, $1.7 million annual run rate. He refined objection handling, upsold 6 clients to premium tier, optimized dashboard insights, shifted all calls to Tuesday through Thursday, plus 14 points close rate. Month 14 revenue, $178,000 per month, $2.1 million annual run rate. He worked 32 hours per week, took 4-week vacations twice/year, built a 6-person team running 80% autonomously. Lesson: structured implementation of quantum principles compounds exponentially when applied consistently over 12 to 18 months. Protocol 15.1. The 30-day sprint plus 12-month roadmap. Complete implementation guide. Objective: install all 14 quantum protocols over 12 months in phase sequence, scaling from current revenue to $1.5 million to $2 million plus while maintaining work-life coherence. Inputs: commitment, 8 to 12 hours/week for protocol implementation, separate from client work. Access to all previous protocols, 1.1 through 14.1. Baseline metrics from week 1 sprint. Support system mentor, peer group, or accountability partner. Steps: month 1, 30-day sprint, execute week 1 to 4 sequence above. Log daily, which protocols executed, metrics tracked, observations. Weekly review every Sunday. Month 2 to 3, continue sprint 1 protocols. Add language mining plus 5 yes. Complete pricing test, implement winner. Monthly deep dive. Compare month 1 versus month 3 metrics. Month 4 to 6, hire first key team member. Build revenue stack. Launch entry plus premium tiers. Monthly dashboard review. Track team leverage hours, revenue per tier, upsell conversion. Month 7 to 9, systematize plus automate protocol 13.1. Launch partnership campaign. Monthly review, hours freed, partnership pipeline, client capacity increase. Month 10 to 12, master objections, optimize resonance, quarterly dashboard deep dive. Identify 1 hidden lever, test, implement. Monthly review, close rate on objections, marketing ROI, revenue run rate. Month 13 plus, ongoing shift to quarterly protocol reviews. Monthly metric tracking. Weekly 10-minute dashboard check. Annual strategic planning to set next revenue milestone, $3 million, $5 million, etc. Measurement. Monthly KPIs, revenue, close rate, ACV, CAC, LTV, referral velocity, revenue/hour, deep work hours. Quarterly KPIs, revenue growth percent, profit margin percent, team size, client capacity, work hours/week. 12-month target, $1.5 million to $2 million annual revenue from $500,000 to $800,000 baseline, 50% plus profit margin, 30 to 40 work hours/week, 3 to 6 team members, 12x LTV, CAC ratio, sample 12-month report. Month 0, $680,000 annual run rate, 56 hours per week, 18% close rate, $38,000 ACV, $620 CAC, 0.8 referral/client, solo operator. Month 12, $2.0 million annual run rate, 34 hours per week, 46% close rate, $58,000 ACV, for $120 CAC, 2.3 referral/client, 5-person team. Revenue growth, plus 194%. Profit margin, 54%. Work-life balance, restored. Systems, 70% automated/systematized. Quantum protocols active, 14/14. Stop/iterate rules. If revenue doesn't grow 20% plus in first 90 days, audit execution. Are you actually running protocols daily or skipping when busy? Consistency beats intensity. If burnout increases instead of decreases, you're adding protocols without removing low-value work. Revisit 80/20's audit and delegate more aggressively. If any protocol doesn't deliver results after 60 days, document why. Then drop or modify it. Not every protocol works for every business model. Customized to your reality. Celebrate wins monthly. Quantum growth is a marathon, not a sprint. Sustainable beats explosive. Ethics note. The 12-month roadmap accelerates growth but doesn't eliminate fundamentals. You still need a valuable offer, real market demand, and ethical execution. Quantum protocols amplify leverage. They don't create value from nothing. Use them to serve clients better, not to extract profit at their expense. Objections and risks. Safeguards against placebo, confirmation bias, and survivorship bias. Any system promising significant results invites skepticism, and rightly so. The quantum selectivity framework is not magic, mysticism, or manifestation without discipline. It's neuroscience, behavioral economics, and measurement rigor packaged as actionable protocols. But 3 risks must be addressed transparently: placebo effect, confirmation bias, and survivorship bias. Risk 1. Placebo effect. I believe it's working, so I feel like it's working. The placebo effect occurs when belief in a system produces perceived improvement, even when the system has no real impact. In business, this shows up as, I'm priming before calls and feel more confident, so I assume my close rate is up, but I haven't actually measured it. Safeguard, rigorous measurement. Every protocol in this framework includes a KPI, baseline comparison, and stop/iterate rule. If you implement pre-call priming but your close rate doesn't improve within 30 days, the data tells you it's not working for you, even if it works for others. This is why the dashboard, Protocol 9.1, is non-negotiable. Feelings lie. Numbers don't. Track before and after for every protocol. If metrics don't improve, pivot. Don't defend the protocol out of ego. Action. Blind yourself to outcome during tests when possible. Example. In pricing tests, don't look at conversion data until you hit minimum sample size, 50 plus per variant. This prevents early result bias from influencing your behavior or interpretation. Risk 2. Confirmation bias. I only notice data that supports my hypothesis. Confirmation bias means selectively focusing on wins and ignoring losses. Example. You run a pricing test, notice 3 high-value clients chose a higher price, and declare victory, ignoring that overall conversion dropped 18% and total revenue decreased. Safeguard. Pre-committed decision criteria. Before running any test, write down your success criteria. I'll adopt the new price only if conversion stays flat or improves and average order value increases by 10% plus and client quality, measured by LTV or referral rate, remains stable or improves. Pre-committing to criteria prevents cherry-picking results to fit your preferred narrative. Action. At day 30, 60, and 90, conduct a full audit with someone external, mentor, peer, coach, or accountability partner. External perspective catches blind spots your bias hides. Ask them, what am I not seeing? What data am I ignoring? Risk 3. Survivorship bias. This worked for one person, so it will work for everyone. Survivorship bias occurs when you see one success story, like Jordan's $240,000, $2.1 million growth, and assume it's universally replicable without acknowledging hidden variables. Market timing, existing skill level, offer quality, network strength, luck, or selection bias. Only winners share their stories. Losers stay silent. Safeguard. Context awareness plus fundamentals check. The quantum protocols work when applied to businesses with valid offers, real markets, and consistent execution. They don't fix broken products, non-existent demand, or poor work ethic. The framework amplifies leverage. It doesn't create something from nothing. Action. Before implementing, audit your fundamentals. Do you have a clear ICP, ideal customer profile, who experiences real expensive pain? A proven offer that delivers measurable outcomes, validated by at least 5 to 10 past clients. Basic sales and delivery competency. You can close deals and deliver results, even if inefficiently. If no to any of these, focus on validation first. Get to $100,000 to $250,000 with scrappy hustle. Then apply quantum protocols to scale what's already working. The ethical boundary. What this framework is not, A guarantee of specific revenue outcomes, market conditions, execution quality, and timing all matter. A replacement for market research, product market fit, or foundational sales skills. A manifestation system that bypasses hard work, discipline, or strategic thinking. A get-rich-quick scheme. It's a 12 to 18-month structured growth system. A license to overpromise or manipulate clients. What it is: a set of neuroscience-backed, protocol-driven tactics that increase leverage when applied consistently and measured rigorously. A measurement discipline that reveals what's working and what's not, so you can double down on winners and cut losers fast. A structure that helps you do less but achieve more by focusing on the highest impact levers, quantum selectivity in action. A framework that scales revenue while protecting work-life coherence, not hustle harder, work smarter. Final safeguard: the 90-day honest test. Commit to 90 days. Track your 7 core metrics weekly. Implement 4 to 6 protocols from the 30-day sprint. If you see measurable improvement, 15% plus revenue growth, higher close rate, better leverage ratios, continue and expand. If you don't see improvement, conduct an honest audit. Did you execute protocols consistently or sporadically? Did you measure accurately or guess? If you executed well and still saw no results, this framework may not fit your business model. And that's okay. Pivot to what does work. Let data, not hope or sunk cost fallacy, guide your decisions. Closing. The 30-day results log in your next move. You've now been exposed to the complete quantum selectivity system. 14 protocols, each mapped to a measurable outcome, each designed to collapse uncertainty into high-probability revenue growth through observation, testing, and disciplined execution. Here's what separates 7-figure entrepreneurs from 6-figure grinders stuck on the plateau. Implementation. Not knowledge, not inspiration, not more strategy. Implementation. The 30-day sprint is your vehicle. It's structured, time-bound, and designed to integrate into a busy schedule without requiring burnout, massive team expansion, or gambling your savings on unproven tactics. The 30-day results log is a simple one-page tracker, updated daily in 5 to 10 minutes, where you log your 7 core metrics, note which protocols you executed, and write one observation. It takes less time than scrolling Instagram, but those 5 minutes create the observation loop that quantum physics teaches us is the foundation of transformation. What you observe, you influence. What you measure, you improve. Over the next 30 days, you'll install quantum selectivity to identify and focus 80% of energy on your highest ROI lever. Observer effect priming to increase high-ticket close rates by 15 to 30 points. Superposition pricing test to lift average contract value by 8 to 20%. Entanglement activation to generate 5 to 15 warm referrals and partnerships per quarter. Coherence rituals to reclaim 15 to 25 hours/week for deep revenue-generating work. Measurement systems to reveal hidden $200,000 to $500,000 optimization opportunities in your existing business. By day 30, you'll have a functioning quantum business system running. By day 90, you'll have measurable proof, not belief, not hope, but data that this framework works for your specific business. Or you'll have clarity that it doesn't, which is equally valuable because it frees you to pivot toward what does. The path from 6 figures to 7 isn't more clients, more offers, more complexity, or more hours. It's more selectivity, more leverage, more measurement, and more coherence. 7-figure operators don't do more. They do less better, with compounding systems that multiply output without proportional input. Quantum physics didn't give us flying cars, but it gave us semiconductors, lasers, MRI machines, and the internet. Practical tools born from understanding how reality operates at the fundamental level. The quantum selectivity framework does the same for revenue growth. It strips away noise, eliminates low ROI activity, and reveals the 3 to 5 levers that actually move the needle from $500,000 to $2 million plus. Your next step is simple. Open a blank document or spreadsheet. Write 30-day quantum sprint, day 1 at the top. Commit to 2 hours today to run the baseline audit. Protocol 1.1. Calculate your 7 numbers. Identify your highest leverage offer tier. Then tomorrow, before your first high-ticket call, run the 20-minute observer effect priming ritual, Protocol 2.1. That's it. 2 actions. Then repeat daily for 30 days, layering in 1 new protocol per week. 30 days from now, you'll either have tripled your pipeline, increased your close rate into the 40 to 50% range, reclaimed 20-plus hours/week, and added $100,000 to $300,000 to your annual run rate. Or you'll have learned exactly what needs to change in your business model, offer, or execution. Both outcomes move you forward. Both collapse uncertainty into clarity. Subscribe and comment 7-figure if you'll run the 30-day results log and commit to the 12-month roadmap. This supports more quantum business content and helps us bring these protocols to entrepreneurs ready to scale past the 6-figure plateau into sustainable 7-figure growth. Thank you for your attention, your discipline, and your willingness to test instead of guess. The quantum shift from 6 to 7 figures isn't mystical. It's methodical. It's not about working more. It's about collapsing your focus onto the few levers that actually compound. And the method is now in your hands. Go apply it. Build your results log. Execute the sprint. Measure relentlessly. Scale strategically. Subscribe to the channel so you don't miss the next audiobooks on the road to 7 digits. See you at 7 figures.